So we have a question today from our friend Patrick. He says, why don't you use the 3 times NASDAQ TQQQ instead of the 2 times NASDAQ QLD? So thanks for the question, and he's talking about our VTS defensive rotation strategy. So the way the strategy works, I mine my volatility metrics, and anytime they are flashing mid to low levels, that would coincide with the times the stock market is stable and profitable, so we hold the 2 times NASDAQ QLD. When volatility is elevated, it's not signaling an all-out crash, but at that point we do have to move to safety, so we rotate into the XLU Utilities ETF. For extreme volatility readings, this is an all-out market crash, and this strategy will be in cash. But the point of Patrick's question here was, why don't we use the 3 times NASDAQ TQQQ? Why don't we go for a little higher return? Well, during stable markets, with that NASDAQ just marching higher, it is actually pretty easy to get lulled to sleep and think that we should add more leverage and chase bigger gains. But the reality of investing is that the vast majority of people out there dramatically overestimate their own risk tolerance, and they don't fully understand what it's really going to feel like in real time when they suffer one of those big drawdowns. Our defensive rotation strategy has been crushing it for years, and it's actually up over 100% in just the last 15 months. But we do have to factor in that the strategy did have a 40% drawdown in 2022. Even though it was short-lived and we're way above all-time highs right now, when we're dealing with leveraged stock market positions, we do have to be careful not to violate anybody's risk tolerance. I don't want to put anybody in the position where they pull the plug and panic sell at the bottom. So it's my job as a risk manager to balance that fine line between maximizing the rate of return and minimizing the risk. Because our defensive rotation strategy is 100% quant-based and systematic, I can literally just show you what the strategy would look like if we used the 3 times NASDAQ, the TQQQ instead. So the black line here is what the baseline strategy using just the 1 times NASDAQ QQQ would look like. This is no leverage at all, and there's nothing wrong with this, a 23.57% return, and it only comes with a 29.79% drawdown. However, because I have successfully managed risk over the years by volatility targeting and rotating to safety when we need to, I personally feel comfortable using the 2 times NASDAQ QLD instead. By doing this, it has increased the annual return to 31.83%. But of course, always remember that risk does cut both ways, and the maximum drawdown was about 10% higher as well, now at 40.22%. For me, given the ratio of return to risk here, this shouldn't violate anybody's risk tolerance, and I think the strategy would be a great addition for any investor. But what about using the triple leverage TQQQ instead? Well, it's definitely going to get a higher return, but the real question is that drawdown still manageable? Every investor makes their own decisions, but in my opinion, no. Even though the rate of return would have been 37.7%, which is incredible, I personally think a maximum drawdown of nearly 50% is just too much. Even though the strategy clearly has the return to recover, how it feels in real time is always a different experience. It's really important for investors to look past what they see in a chart and try to put themselves in the position of a person who is suffering that drawdown. It will feel different, so just remember that your risk tolerance probably isn't as high as you think it is. Our official defensive rotation strategy using the 2 times NASDAQ is already at over a 30% return with a manageable drawdown. If that's not enough, I really don't know what to tell someone. So to you, Patrick, as a VTS subscriber, of course you can make any ETF replacements that you think is appropriate for your own portfolio. On my end, though, all I can tell you is what I personally do with my own money, and I feel perfectly comfortable with just the 2 times QLD. Successful investing is a marathon, not a sprint. You don't have to chase big gains.